Okay guys, welcome to this lesson on non-trading sessions. Now, one very important quote or principle you need to understand is that knowing when to trade is just as important as knowing when not to trade. And this is the lesson that I'm about to teach you. When should you not trade? Some important principles you need to take note of. Like I said, knowing when to trade is just as important. Learn how to minimize your losses and maximize your gains. Sometimes the best trades are those that you didn't make. Okay, give it a miss. You don't have to take every trade that are not according to your trading plan or not high probability. You gotta trade like a sniper rather than a machine gun. A lot of traders I find is that when they get bored, they are going to start trading again and again and again. And when they don't have trades today, they are going to get itchy finger and then they're going to break their trading plan. You gotta be a sniper. It's better to take one high probability trade than 10 mediocre trades. I always say this in my seminars. And people only learn this the hard way, unfortunately. So make sure you learn this the easy way. Having no trades for a few days is normal. You just gotta accept the fact. Because you're not a scalper. You're not trying to make 50 trades a day, 100 trades a day. It is just very unproductive. Because when you're making so many trades a day, you're making a broker rich. You're not making yourself rich. You're paying him or her commissions every single day. I find that the less trades I open, the more profitable I become. The more trades I open, the more money I'll lose. Okay, so it's not about having as many trades as possible. Now, when should you not trade? Number one, 1 hour, or to be safe, 1.5 hours. Or to be super safe, 2 hours before high impact events. So let's say, for example, today you're trading Aussie dollar. You wake up 6 a.m. and you have a trade. It's 2 hours before a high impact event, which is the red color ones over here. Would you trade? No, don't enter. Let's say you're trading Aussie dollar. You have a trade at, let's say, 8 p.m. But on 9:30 p.m. there is a high impact event. Would you go in and enter a trade? No, you should not, because your technical analysis will not work out during high impact events. And not only that, there's going to be high volatility and you are going to be stopped out most of the time. And the second thing is when there's conflicting time frames. Example, you can see this is the H1 chart of pound yen. This is the H4 chart of pound yen. I drew these 2 points over here. It is on the same day, same exact time. Now you can see that oftentimes there's going to be conflicting signals. If you look at H1, right at this point, it is telling you to sell. Okay, 50 is below 200. Price is below all the moving averages. It's telling you to sell, right? If you shift to H4 in a bigger picture, price is still above 100, still above 200, and 50 is above 100, 100 is above 200. So in this case, what should you do? Should you buy or sell? H4 is telling you buy, H1 is telling you to sell. So if there are conflicting signals, don't trade. Simple as that. Because even though in H1 you're trading along with the trend using a sell trade, but in H4 you're actually trading against the trend. Surprise, surprise. Now, third rule you need to understand is don't enter when the price hasn't touched 20 SMA. Okay, if you have went through my beginner course or if you have paid attention during the moving average lesson, then you know why you shouldn't enter. So example, if I have a buy trade over here, this is the start of the day. This is the period separator. Would you enter a buy trade here? And you put your stop here? No, because when you enter a buy trade here, when the price has to touch 20 SMA, then it has to go down. Understand what I'm saying? If you have a sell trade here, would you sell? No, because first thing first, it is so far from the moving averages, it has to go back, right? Some more, at this point in time, it hasn't touched 20 SMA for the day, from the start of the day, which is here. And when it has to touch, it will have to go back up. So if you sell here, you will die, okay? And also number 4, don't enter on overbought when you are trading an uptrend. Okay, a lot of traders, they use momentum indicators the wrong way. When they see overbought, they are going to enter on a sell trade. Now the thing about price giving you overbought signals in an uptrend, it's just a signal that the uptrend has a strong bullish momentum. That's it. It's not telling you to sell right here, right here, right here, and right here. For example, if you sold here at this point, you can see what happened to the price after that. Continues to go up. Again, surprise, surprise. So in an uptrend, you only look for oversold signals. And also at the same time, don't enter on oversold when you're in a downtrend. Because oversold signals in a downtrend, it just means that the bearish trend is going to get stronger and stronger and stronger. Unless it is at the end of the downtrend, it probably means that the downtrend has ended. But if you see oversold signals at the middle of the trend, then it just means that the bearish trend is strong. The force is with the trend, okay? So you cannot buy here when it goes to oversold. You see, if you buy here, first thing first, you're breaking a major rule, which is trading against the trend. Secondly, it is far away from moving average. If you bought over here when the RSI went to oversold, look at where the price went. It went ranges a little bit, then it comes down. Okay? And then if you bought over here out of revenge trade, okay, over here, this example, again the price drop again and again and again. So in a downtrend, just look for a trade when the momentum indicator gives you an overbought signal. Okay, in a downtrend, ignore oversold unless you're at the end of the trend. Number 6, also don't enter 1 hour after high impact events, because sometimes it takes some time for the event to settle down. Okay, so if you enter immediately after the high impact event, when the volatility is still there, high chance you're going to get stopped out. Understand what I'm saying? For example, right here, you can see how much the price would move during a high impact event, which you're going to get easily stopped out either way. Okay, so in this case, a lot of people ask, then Karen, what should I do when there's no trades? So I'm going to give you a to-do list. There are many things you can do. Doesn't mean that if your name is a trader, then you have to trade every single day. It's just like if you're a singer, do you need to sing every day? No, sometimes you need to write your songs. Sometimes you need to practice your piano. You know what I'm saying? You can do many different things. As a trader, you can read books. You can learn from a mentor. You can meet your mentor and then talk to him or her. Have a coffee, have a chat. And then you can also watch video tutorials to upgrade yourself, whether on YouTube or this online course. And then you can also backtest your current strategy, or you can develop new strategies. You can also review your trading journal. You can also develop a new trading plan, like I said, strategy. Or you can just do a lot of things that's going to benefit your mental health, enhance your trading performance. Like for example, exercise, meditation. It helps. Trust me, it helps. Improve on your trading plan as well. You can also work on a specific skill. For example, risk management. How to calculate lot size. How to calculate value per pip. How to manage your trading psychology. You can also go out and network with other successful traders. You can also attend trading expos, conferences, meetups. There are so many trading events, especially in Singapore. I don't know about your country, but there are just so many events that are catered to traders and investors. If not meetup groups or book clubs, this is something that I really like. Wealth triggers to get inspired. For example, if you really like the luxury things in life, okay, not everybody likes it, but some people like it. For example, if you like cars, sports car, if you have a dream car, you can just take a visit to the sport car showroom, and then what you're going to experience is that you're going to get inspired to work harder on your trading or your investing, so that you can one day buy the sport car of your dreams. I can tell it really helps. If your dream is to join a yacht club, golf club, then just pay a visit there for one day. And then when you visit there, you see all the so-called wealthy people, you're gonna get inspired to work hard. It's a very weird thing, but it works, okay? If you're demotivated, if you cannot find inspiration, wealth triggers help a lot. And also, like I said, work on your physical and mental health, okay? Because if you feel like SHIT, okay, your trading performance is going to get affected. Okay, so with that, I hope that this gives you a clear idea on what to do when you're not trading and also when not to trade. Okay, so with that, I'll talk to you in the next lesson. Bye.